Hey, what's going on, guys? Welcome to the Echoes from Above show. And today we are going to talk about something extremely important that I want every single investor to understand about the market this year. And so let me just go ahead and get right into it. First off, feel free to like, share, and subscribe. Please feel free to like the video. That really helps the algorithm. That really helps my channel grow. And thank you so much to everybody who is subscribed. And for all the new people, please feel free to subscribe. And so now let me go ahead and get into it. A lot of investors are going to lose a lot of money this year. And I made a YouTube video about it already, but I'm making another video because it's very important that you all understand this, and it's very simple. This is going to be a short video. The reason why a lot of investors are going to lose money is because you have seen a market rotation out of growth stocks and companies that are unprofitable, mostly into companies that are profitable. Now, obviously, for the most part, tech is down huge, so this doesn't apply to everything. But if you want my honest opinion, I think that this is going to be the year of the value stocks and the companies that are profitable. I think the companies that are not profitable are going to lose money. And I think for people who have a bunch of speculative, unprofitable growth stocks in their portfolio, you can expect that you probably not only will you not outperform the S&P 500 or any of the indexes, but you're also probably going to lose a lot of money this year because this is going to be a bad year for growth stocks. And the main reason why is because of those interest rates. That's just how it works. Now, let me also say this. Do I still hold SoFi? Do I still hold Snapchat? Do I still hold DraftKings? Yes, I still hold those stocks. I still love those stocks. However, I do not expect to make money this year in those stocks. And let me go ahead and say that again. As much as I love SoFi, as much as I love DraftKings, Snapchat, PayPal, whatever, I do not expect to make money in those stocks this year. That's the God honest truth. But the reason why I continue to hold is because I expect to make a ton of money in those stocks within the next 3 to 5 years. But this year, I do not expect that to be the case. And it's very important that you guys understand that. And if you just go back in history and look at what happened when the Fed raised rates in 2018, and you'll kind of get a clue of what I'm talking about. But I think that as of right now, the market rotation is pretty apparent. I mean, you're seeing some like historic things happening. Like I saw an article that said that historically, the most money managers, I guess, in stock market history or since 2000, I guess, 2004, have exited tech stocks. Like this is the largest amount of hedge fund managers who have left tech stocks and pulled their money out like ever. And if you look at the NASDAQ, like something crazy, like 50% of all of the stocks in the NASDAQ are down like 40-50%. Which kind of tells you everything that you need to know. And what's mostly been carrying the NASDAQ has been like 4 or 5 stocks. It's been like the 4 or 5 top stocks. And it's important to understand and recognize things like this because like I said, I'm never going to leave my position in DraftKings or SoFi or Snapchat because I am extremely bullish in those companies. But sometimes you just got to recognize that, hey, you know what? The market, those stocks just aren't going to be hot this year. You know, those stocks are probably going to keep getting killed. They're probably going to keep going lower. I mean, if SoFi were to go back to $10, I wouldn't be surprised. It could happen. You know, if the indices go down even more, like we're not even in a correction yet. You know, the indices are going down, but they're not in correction territory yet. Like they're not down 10, 15, 20%. But if you start to see things like the S&P 500 or NASDAQ go down to those levels and we actually get a correction, then you can expect like stocks like DraftKings could break $20 and go to like $17, $18, $15. You could expect SoFi to break $10 and go to like $8 or $9. I mean, you could expect these growth stocks, these unprofitable companies, to go down another 10, 15, 20%. That's just how the market works. When there's panic and everybody's selling, then everybody just sells. And the stocks that get hit first are the more risky stocks. And the growth stocks that are unprofitable, unfortunately, are the more risky stocks. And so I just really want you guys to understand this. Like I said, I'm not selling any of those stocks. I'm going to keep them in my portfolio. I just recognize that I'm probably not going to make money in those stocks this year. You know, it'll be within the next 3 to 5 years that I make money within those stocks, which is why I'm still going to hold because those are great companies. But this year, I think your main focus should be the profitable companies. I think the profitable companies, and whenever we get this correction, I think buying index funds would not be a bad idea either. But I think you should stick to the companies that are very, very strong balance sheets. You know, some of the top companies in the world, you know, for example, the Apples, the Teslas, the Microsoft, you know, companies like that, Google. I think those should be the main focus of your portfolio this year because I'm telling you right now, a lot of growth stocks are going to get destroyed and a lot of investors are going to lose money. And I do not want that to be you. So thank you guys so much for watching this video. Feel free to like, share, and subscribe. And that'll pretty much conclude this video. And so I will see you guys in the next one.